There's an old line traders like to repeat, one that gets attributed back to George Soros. It's not about being right or wrong. It's about how much you make when you're right and how much you don't lose when you're wrong. I think about that line almost every single day, and I want to be straight with you before we go any further. My conviction on what's about to happen in gold and silver is about as high as it's been in a decade. Not because I'm an optimist. I don't make money being an optimist, and I don't make money being a pessimist either. I make money being right about mechanisms. And right now, the mechanism is lining up in a way I've only seen a handful of times in my life. Let's just be honest about the last few weeks, because I know a lot of you lived through this with me. Gold ripped higher, silver followed, and for about 10 glorious days, everybody watching this channel felt like a genius. Then it turned fast. The kind of pullback that makes you question everything. Was the thesis wrong? Did you miss something? Should you have taken profit when you had it? I got messages from people who were up 5 figures on paper and then watched half of it disappear in under a week. If that was you, I'm not here to tell you it didn't hurt. It did. But I want to tell you what you actually missed, because it wasn't the top. It was the setup for the next leg. So let's slow down and actually build this out piece by piece, because most people watching gold headlines never see the chain underneath them. It starts with oil. When energy prices move, they move fast into inflation expectations. That's not opinion. That's just how CPI baskets work. Once inflation expectations shift, the Fed has to respond, or at least be seen to respond, because credibility is the only tool a central bank actually has. That response shows up in real yields. And real yields are the entire ball game for gold, because gold pays you nothing. Zero coupon, zero dividend. So imagine you're a big institutional allocator and you're asking yourself the obvious question, why would I sit in an asset that pays me nothing when I could be earning a real yield somewhere else? That question is the whole trade. When real yields fall, or when the dollar weakens alongside them, that question flips, and suddenly gold isn't the asset with nothing to offer. It's the asset offering the only thing that matters, which is protection. This isn't theoretical. Go back and look at 1973, 1979, 1991, 2001, and 2022. Different decades, different presidents, different Fed chairs, same mechanism, same result. Here's where it gets interesting though, because if this was just the pattern repeating, I wouldn't be telling you my conviction is at a decade high. Patterns repeating is normal. That's just markets. What's different this time is the starting point. I want you to sit with one number for a second. Central bank gold buying has been running at a pace many analysts describe as the strongest sustained buying in decades, driven largely by countries actively working to reduce their dependence on the dollar. Sit with that. This isn't retail buying. This isn't ETF flow. This is sovereign balance sheets making a structural decision, and structural decisions don't reverse in a quarter. Now let me talk to you about who's actually doing the buying, because it matters. It isn't just the usual suspects. You've got central banks across multiple continents accumulating gold reserves at a pace that, by many estimates, would have sounded absurd just 5 years ago. The reason isn't mysterious. It's a hedge against exactly the kind of currency and geopolitical risk we've seen play out repeatedly this decade. When a central bank buys gold, it isn't trading, it's insuring. And insurance doesn't get sold back the moment the price wobbles. Now let me bring this to silver, because silver is playing a different game than gold entirely. Gold is a monetary metal. Silver is both a monetary metal and an industrial one, which means it's got two separate engines pushing it at once. Solar panel demand alone has become a serious call on physical silver supply, and that's before you even get to electronics and electrification more broadly. Here's the number worth sitting with. The gold to silver ratio historically has spent long stretches much tighter than where it sits today. If that ratio simply reverted toward its long-run historical average rather than today's stretched level, silver would need a dramatically larger move than gold just to close the gap. That's not a prediction of exactly what happens. It's a way of showing you how much room silver has if the historical relationship reasserts itself. Now let's talk technicals for a second, because I know some of you live and die by the charts. What we saw in the recent pullback looks, on a lot of the time frames I follow, less like a top and more like a shakeout, a move designed to flush out leveraged longs before the next push. That's not me being a permaball. That's just what these patterns have tended tended to look like historically before continuation moves versus what they look like before an actual reversal. I want to give you a framework here because I think it explains almost everything about how retail investors behave around moves like this, and I've seen it play out the same way over and over. Phase 1 is disbelief. The move starts, and almost nobody who isn't already positioned believes it's real. Phase 2 is grudging acceptance. The move continues. Some people start nibbling in, but most are still waiting for a pullback that validates their skepticism. Phase 3 is the pullback everyone was waiting for, and this is the cruel part because it's exactly when most retail investors finally get scared out, right before phase 4, which is capitulation into euphoria. The point where the people who waited the whole way finally pile in, usually near the top of that particular leg. Every single phase ends the same way. Retail does the understandable thing at exactly the wrong moment. It's not that people are unintelligent. It's that the framework is built to exploit patience and impatience at precisely the wrong times. I know some of you are sitting in losses right now from that pullback, and I want to say something to you directly. That feeling, the doubt, the second guessing, wondering if you got the whole thing wrong is completely normal, and it is also completely useless to you. It doesn't change the mechanism. It doesn't change what oil is doing to inflation expectations. It doesn't change what central banks are doing with their reserves. It doesn't change the industrial squeeze on silver. Feelings are real, but they aren't information. Let's recap quickly where we are. Inflation pressure feeding into Fed policy, real yields as the key transmission mechanism, record-pace central bank buying, silver's dual monetary industrial demand, and a technical setup that looks more like a reset than a reversal. But here's the new variable that I don't think enough people are pricing in. This cycle is happening alongside an open conversation about who leads the Federal Reserve next, and names like Kevin Warsh, a former Fed governor known for a more hawkish, inflation-wary lens on monetary policy, have been part of that conversation. Whoever ends up in that seat inherits a Fed that's already navigating a very delicate balance between fighting inflation and not breaking something else in the economy. That uncertainty alone tends to be exactly the kind of environment gold has historically thrived in. It brings me back to that Soros idea from the very beginning. This was never about predicting the news with certainty. It's about being positioned so that when the news breaks the way historical patterns suggest it might, you're not scrambling to catch up. So let's make this practical. First, watch real yields, specifically the 10-year TIPS yield, because when that number falls while inflation expectations stay sticky, that's the green light this whole mechanism runs on. Second, watch the dollar index, because a weakening dollar and rising gold have tended to move together, and a breakdown in the dollar index is often the earliest confirming signal. Third, watch central bank buying reports, which come out periodically through sources like the World Gold Council, because sustained buying at these levels tells you the structural bid isn't going anywhere. Fourth, watch the gold to silver ratio itself, because a ratio that starts compressing tells you money is starting to rotate from gold into silver, which is often a sign of a broader precious metals move gaining conviction rather than losing it. Now let's zoom all the way out, because I think it's easy to lose the forest for the trees here. In 1944, the world built a monetary system around the dollar backed by gold. In 1971, that link was severed entirely, and gold became what some call a monetary orphan, an asset with no official role, trading purely on trust and scarcity. Everything we've talked about today is really just a chapter in that much longer story about what happens when the world quietly starts questioning how much trust a single currency deserves. So let me leave you with this, because I think it matters more than any single number I've given you today. This was never really about whether gold hits some specific price target or whether silver catches up to some historical ratio. It's about how you think, not just what you think. Going back to that idea from the beginning, it was never about being right. It's about sizing your conviction to match your evidence and being honest with yourself about the difference between a thesis and a certainty. So I'll ask you directly, knowing what you know now about the mechanism, about the central bank buying, about silver's dual demand story, about the technical setup, would you want to own some of this yourself? If this was useful to you, share it with somebody who's been asking you about gold and silver lately, not because it does anything frustrating for me, but because I think more people deserve to actually understand the mechanism instead of just reacting to headlines. As always, this isn't financial advice, and I'm not your financial advisor. Do your own research, size your positions the way that lets you sleep at night, and take care of yourselves out there. I'll see you in the next one.